Right, guys. So in this particular session, what we'll be discussing about is Mehran. Okay. So what we've been given is that let's read out the question carefully. So Mehran is a public limited company. It operates in number of business sectors, including farming, mining, and retail. The directors require advice about how to apply fair value measurement. Okay, IFRS 13. So they require guidance on IFRS 13. Okay. So farming, mining, and retail. Okay. So number one will be Mehran just acquired a company which comprises of farming and mining business. Okay, mining business is normally a bit longer period. Mehran wishes advice on how to fair value some of the assets acquired. Okay, so as per IFRS 3, always the assets which are acquired is valued as at fair value, right? That's how we calculate the goodwill. So on such assets is a piece of land which is currently used for farming. The fair value of the land if used for farming is 5 million. Okay. If the land is used for farming purposes, a tax credit of 0.1 million arises. Okay. Mehran has determined the market participants would consider that the land could have alternative use for residential purposes. The fair value of the land for residential purposes before associated cost is thought to be 7.4 million. In order to transform the land from farming to residential use, there would be a legal cost of 0.2 million, a viability analysis cost of 0.53 million, and then the demolition cost of farm buildings of 1 million, right? So 1 2 3, right? 6 million. So 0.6 million out of this, right? That would be the cost. Additionally, permission for the residential use has not been formally given by the legal authority, and because of this, market participants have indicated that the fair value of the land after above cost would be discounted by 20% because of the risks of not obtaining planning permission. Okay, so after that, right? In addition, Mehran has acquired the brand name associated with the produce from the farm. Mehran has decided to discontinue the brand on the assumption that it is similar to existing brands. Mehran has reminded if it ceases to use the brand, then the direct benefits will be 20 million, and if it continues to use the brand, then the direct benefits will be 17 million, right? If it ceases, indirect benefits will be 20 million, and direct benefit will be 17 million. Other companies in the market do not have brands that are as strong as Mehran, so this would not see any significant benefit from the discontinuation. Okay. So discuss the way in which Mehran should fair value above assets and with reference to the principles of IFRS 13, right? So in this particular case of planning thing, like we don't need the legal permit, okay? So it's the best use of the asset, right? Uh, that's how we fair value, right? So let's talk about it. So we are required to talk about IFRS 13 first thing first, and then after that, what was the other thing? That brand. Non-financial asset. So we will be talking about both things, right? Financial assets. So IFRS 13, what is it about? Fair value measurement, right? Measurement requires the fair value of non-financial asset to be measured on its highest and best use. This is determined from the perspective of market participants. It does not matter whether the entity intends to use the assets differently. The highest and best use takes into account the use of the asset which is physically possible, legally permissible, and financially feasible. IFRS 13 allows management to presume that the current use of an asset is the highest and best use unless factors suggest otherwise. So let's talk about land first of all. Land, right? So if the land zone for agriculture use is currently used for farming, the fair value should reflect cost, structure to continue operating the land for farming, including any tax credit, which could be realized by market participant, right? Thus, the fair value of the land if used for farming would be, how much was the value of the land again? 5 and 0.1, right? So 0.5, I mean 5.1 million, which is basically $5 million plus $0.1 million. Right, so what about the other thing? The agricultural land is to have an alternative use as market participants have considered its use for residential purpose. This instead, right? A use of an asset need not be legal at measurement date, but it must not be legally prohibited in the jurisdiction, right? So it should be legally permissible. uh, I mean, even though the legal permit has not been obtained, it should not be a prohibited kind of thing. Okay, so if used for residential purpose, value should include all costs associated with changing the land to market participants. Intended use. Intended use, right? In addition, demolition and other costs associated with preparing the land for different use should be included in the valuation. These costs would include the uncertainty related to whether the approval needed for changing the usage would be obtained, right? Because market participants would take that into account when pricing value of the land if it had a different use. Whether the approval needed for changing the uses would be obtained, right? Because market participants would take into account when the pricing value of the land if it had a different use, right? Thus, the fair value of the land if used for residential purpose. How much million? So 7.4 minus 0.2 minus 0.3 minus 0.1 and then minus 20% as well, right? out of that 80%, isn't it? So would be discounted by 20%, right? Indicated the fair value of the land after the above cost would be discounted by 20%. Okay, so 80%. So what we could do is that let's do the calculation first of all. So it's 7.4 minus 0.2, 0.3, 0.1. Right, okay. 0.2, 0.3, 0.1. So 6.1 minus 20%, 5.44. Okay, so I'll just copy this whole thing. So 5.4 million. How much was it again? 4 million should be. That's right. So this is how we get the fair value. So in this situation, so it would be this 5.44. Okay, so situation assumption that current use is the highest and best use of the land has been overridden by the market factors. Which indicate that the residential development is the highest and best use. Therefore, the fair value of the land would be 5.44 million. Still in future, right? We're just advising them. So yeah, who would be? So next thing we need to talk about is brand. So IS38. So in case of brand as well, in absence of any evidence to the contrary, Mehran should value the brand on the basis of highest and best use, by market participant, even if Mehran intends for different use. Okay, so even though if it's going to be used for something else, the valuation will be done on a highest and best use. Okay, it does not matter whether the entity intends to use it differently. Market participants would discontinue, right? Because indirect benefits is 20 million and 17 million, right? So this would not see any significant kind of thing, so we will lose that. Would not. So what would market participants do? They would not discontinue the brand, right? Because their existing brands are less strong. Instead, market participants would continue to use the brand in order to obtain its benefits. So what did it determine? Indirect benefits will be 20 million. Okay. So Mehran's decision to discontinue the brand is therefore not relevant in determining fair value. As such, fair value of brand is $17 million. So the market has basically said that the other brands are strong. So what they would do, they would not actually try and lose this one as well. That's why we value it only at 17 million. Okay. So it's not about the valuation only, but it's about the highest and best use. How would the market participants actually measure it? Okay, or what would be it from a perspective of a market participant? Okay, that is more important. So next thing is what is it regarding? Okay, so this is done. So let's move on to B. So Mehran owns a non-NCI interest in Aram, a private company, and wishes to fair value it as its financial year end of 31st March 2006. Acquired the ordinary shares interest in Aram on 1st April 2004. 2 years back, right? During the current year, financial year, Aram has issued further equity capital through the issues of preference shares to a venture capital fund. As a result, the preferred share issue, the venture capital fund now holds a controlling interest in Aram. The terms of the preferred shares, including the voting rights, are similar to those of the ordinary shares, except that the preferred shares have a cumulative fixed dividend entitled for a period of 4 years. Mhm. The preferred share rank ahead of ordinary shares upon the liquidation of Aram. The transaction price for the preferred share was 15 per share. Mehran wishes to know the factors which should be taken into account in measuring the fair value of the holdings in uh, ordinary shares of Aram at 31st March 2006 using a market-based approach. So this is about IFRS 9 as well, right? Financial asset. But we are required to fair value it. So how do we do it? That's the question, right? It's not number B, it's just number 2. IFRS 13 and financial asset. That's it, okay. So there's only one asset, right? We're talking only about the equity interest. So IFRS 13 fair value measurement states that fair value is determined is a market-based measurement, although it acknowledges the observable market transactions. Might not be available whether or not observable information is available. The aim of IFRS 13 is to estimate the price at which an asset would be sold in an orderly transaction between market participant at the measurement date. Okay, not at the future, but at the measurement date. The market approach takes a transaction price paid for identical or similar instruments and adjust it using a market approach. Mehran could take the transaction price for the preferred share and adjust it to reflect certain differences between the preferred shares and the ordinary shares. For example, there would be an adjustment to reflect the priority of the preferred shares upon liquidation. What else did it say? Mm, voting rights are similar to those, except those have a cumulative dividends entitlement for the. Mhm. Mehran should acknowledge the benefits associated with control. This adjustment relates to the fact that Mehran's ordinary shares represent a non-controlling interest, whereas preferred shares issued reflect a controlling interest. Alright, so they have a controlling interest, right? There will be adjustment for the lack of liquidity of the investment, which reflects the lesser ability of the ordinary shareholders to initiate a sale of Arham relative to the preferred shareholder. Cumulative dividend is also there, right? Entitlement preferred shares, they should be calculated as the present value of expected future benefit, expected future dividend, I could say, dividend receipts on the preferred shares less the present value of any expected dividend. That's the difference, right? The receipts on the ordinary shares. Difference between two, okay. Mehran should review circumstances of the issue of the preferred shares to ensure that its price was a valid benchmark. In addition, Mehran should consider whether there have been changes in market condition between the issue of preferred shares and the measurement date. That should also be considered. Okay, so what was the condition during the preferred share when it was issued, and what is it now? Okay, so this is done, so we can move on to the other. So what do we have over here? So Mehran has recognized provision in its financial statement for the year ended 31st March 2006. It has produced the following provisions disclosures. Okay, customer refunds this much, charged to SOPL this much, utilized this much. Okay, so closing balance was this much in case of customer refunds, right? Provision. So this was utilized. Okay, in reorganization, and then this one as well, right? Of which current is this, for reorganization is this, total is this, non-current is 0.6, right? So provision for customer refunds reflect the company's expected liability for returns of goods sold in retail stores based on the experience of rates of return. Yep, that's how we basically estimate it. Provision for reorganization reflect restructuring and redundancy cost principally in relation to our retail operation as well as restructuring in finance and IT. The directors of Mehran has been asked by investors to explain the accounting for provisions in the financial statement and to explain why the reasons provided in the provision disclosure note is useful. Explain to the investor the nature of the accounting for provision in financial statement, and your answer should explain benefits and limitations of information provided in disclosure notes, right? So okay, first thing first, accounting for provision. Accounting for provision. Second thing that we will talk about is benefits and limitations. Right. So in case of accounting for provision, what we will talk about is IAS 38. IAS 37, I mean 37, provision contingent liabilities and contingent assets. Defines provision as liabilities where the timing or the amount of future outflow is uncertain. Is a liability where the uh, timing of outflow is uncertain, right? A provision is recognized. Provision is recognized if it meets the following criteria. First thing first is our should be probable. And the outflow is probable. Liability can be measured. Outflow of economic resource is can be measured reliably. Third thing being there is a present obligation. Illegal or constructive as a result of past event obligating. Okay. Provision should be measured at the best estimate the economic resource required to settle the obligation. It should be remeasured each reporting date using the best available information. If the time value of money is material, then provision should be discounted to present value. The discounted would be should reflect the risk specific to the liability. Okay. So if it is material, it should be discounted to present value. That is the most important thing. If you want to take away something from today, then this will be your takeaway. Okay. You don't basically see this much. So you basically what we normally do is that we don't basically discount it much, right? When we are creating a provision, like unless if it's material. So what will be the limitations and benefits? Provisions involve uncertainty. Disclosure should provide to help users understand the nature of the obligation, the timing of any outflow of economic benefits, uncertainties about the amounts or timing involved, and major assumptions made. So the amount and timing, that's one thing. So timing of the economic benefits will also be shown, because as you can see in the disclosure C, you know the timing, right? So this was utilized, right, among the provision. So as you can see the timing, so probably next period as well. So this much figure might be expected, right, around that figure. So that gives us a rough sense of timing as well. And then what was the major assumptions that were made so that the provision reflects that particular amount. Okay. Disclosure note splits the provision between current and non-current liabilities. This helps users of the financial statement assess the timing of the cash outflows and the potential impact on Mehran's net cash inflows. It would be useful to provide further information about the expected timing, the outflows classified as a non-current liability, right? So they have a basic rough time frame in their mind. Financial reporting focuses on past events, but provisions disclosures also provide important information about the future. Disclosure note informs investors about the restructuring activities within the store, but also in finance and IT. Whilst it is restructuring will incur costs, investors may value Mehran effort streamline its operations and improve efficiency, right? That's why they do restructuring at the end of the day to improve the operation, right? Or you could say to increase the efficiency. Disclosure shows that provisions as a total balance increased on year on year, always entails entail risks, right? Risk because there is an obligation to make payments to settle the obligation, even if the company has insufficient liquid resources to do so, right? Provisions might be viewed as particularly risky because they are estimated and therefore the actual cash flow, actual cash outflows required might be significantly higher than estimated. Some investors may be deterred from investing in companies with substantial provisions, right? With regards to the refund provisions, the amount utilized in the reporting period is what has happened, utilized. Utilized is more, right? Okay, in case of refunds, right? In case of this, it is more. Okay. The amount utilized in the reporting period is less than provision at the start of the year. This suggests that in the prior year, management had overestimated the refund provision. This information may cast doubt on the management its ability to accurately estimate its provisions and increase uncertainty regarding Mehran's cash flow. Further information would be provided to the users assess the adequacy of the provisions made. Part of the restructuring provision is classified as non-current. No information is provided about discount rates. Alright, very little information is provided about any uncertainties that would impact the measurement of provision or the assumptions made. That's also not provided. This hinders the user's ability to assess the adequacy estimates made by management. So it does not actually allocate that cost, right? In case of IT and finance, it just says IT and finance. So segregation within this reorganization also could be a good thing, that people know whether it's a restructuring within the finance department or IT department, right? That would also be important. So based on the rates of return, right? Okay. Experience of return, and then does not include anything about discount rates. We covered that. And then anything else, whether it is material or not. If it would have been discounted, then it would be material, right? That would be the assumption. Whereas they have not given us any information about that, so it's not possible. Anything else that we missed? So did not talk about the assumptions, what assumptions were made, right? And then uncertainties as well, does not talk about that. Why is it non-current? So what kind of finance and IT department? I think the restructuring should not take that long, right? Whether if it's a data migration, maybe that could be a problem or something else of that sort. But IT and finance, it's like does not take long time for restructuring, right? So we could talk about that as well. So that's pretty much it, guys. So this is how we answer this kind of question. So if you have any questions until now, please do comment down below. I'll be looking forward for your comments. So I'll see you in the next question, which will be question number 31 about car sound. Okay. So until that time, bye bye.